This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. Dana Peterson knows a bull market when she sees it. Chief Economist at the Conference Board with wonderful perception on the American consumer. Dana, how do you link a quiescent inflation report like this over to retail sales on Thursday?
Well, I think the key thing is that we are seeing inflation slowing, and it's consistent with what the Fed expects. But as was mentioned earlier, real wages are rising, and certainly it's supporting consumer spending. But when we ask consumers how they feel, they're still complaining about inflation. They're still saying that everything's too expensive. Interest rates are rising, so that means if you wanted to buy that car or refrigerator, it's going to cost more. So I would expect that even though real wages are rising, inflation is still there, and consumers are probably going to start pulling back on spending.
How are real wages doing? And within that, are they is it almost circuitous where they're actually part of the inflation report as we adjust for inflation with wages?
Well, I think wages are a part of the inflation story. Certainly, you have a number of industries that are experiencing labor shortages. And when you look at their wages, nominal and real, they're still rising pretty quickly. And I think that's showing up in the services aspect. Let's also not forget that insurance costs are rising because many of these insurance companies are suffering losses and they're raising premiums. So between insurance and wages, we still have these sticky inflation measures. And I don't think that's going to go away right away.
So, Dana, do you think that people are a little bit overzealous about this idea that the Fed is going to cut rates significantly next year?
I think they are. Indeed, the Fed tomorrow is probably going to signal, yes, it's done, but don't expect rate cuts anytime soon, and don't expect that many next year. We think anywhere from 50 to 100 basis points probably makes sense, especially if inflation, according to the SEP, doesn't get beyond 2% before the end of next year. So I still think that, yes, we can get to 2% by the end of next year, but that's really going to suggest that not many interest rate cuts are priced in.
Was transitory right, Dana? Are we just basically seeing the right sizing of the supply side after the pandemic, and that's entirely what we're seeing now? Or is this disinflation transitory? Is this basically a period of a head fake before some of the stickier elements take place in a more significant way?
Well, I don't know why people are surprised that inflation gauges are slowing. The Fed did raise rates by 525 basis points. This is part of the program. Certainly, we saw the housing market slow first, and that's showing up with a significant lag in the rental components of the CPI and the PCE deflator. So that's slowing things down. Certainly, food and energy prices are determined by things external, and we don't have the massive disruptions from OPEC or even wars affecting energy prices, so they're coming off. But you still have the influence of insurance costs and wages because labor shortages are here. And I think those two things are going to be the challenge to getting inflation back to 2%. But we can still get there.
Dana Peterson, this is the Conference Board. Dana, please stay with us. We're going to come right back. A market check here because you saw a spike, whichever way your series going, and we've sort of given it back. S&P futures had a nice pop. They've given it back up 6 right now. Same thing in the yield space. A 10-year yield, 4.21%. I noticed the real yield was a 197. It's come back nicely, 2.01. Perhaps we're already on the way to adjusting for the Fed meeting tomorrow. Dana Peterson, what is nominal GDP? How about Chairman Powell? He watches every morning. What's your estimate here of the animal spirit of Chairman Powell's America?
Well, I think, nominal GDP is certainly, nominal and real GDP are probably not going to be as strong as what we saw in the third quarter. We're probably looking at growth around, 1% in real terms and roughly 4% in nominal terms, right? Adding in, roughly 3% headline inflation. So that's a slowing economy. And I think, again, that's part of the program. The Fed wants to see the economy slow to help bring down inflation. Now, when we look at business investment, that's already slowing outside of manufacturing, where companies are bringing back product and production and they're building factories. Away from that, there's really not that much investment. The last shoe to drop has to be the consumer. And we know consumers are more indebted now. Their interest rates on their credit cards are higher. Student loan payments are coming back. And, consumers are quitting less and they're thinking, well, maybe the labor market's going to slow, so maybe I should also slow my spending as well.
Dana, I'm just curious. We're seeing that shelter prices pretty much offset the decline from oil prices. Is that sustainable, or do you think that this is just sort of a lag before we start to see housing costs inflect downward?
Well, I don't really look at the month-on-month for housing. I look at the year-on-year. And year-on-year, the rental components are slowing, and it's consistent with an 18-month lag of the Case-Shiller Home Price Index. So we're seeing this happen. Month to month, you're going to have bumpiness, but it's a year-on-year growth rate or rate of inflation that we should be paying attention to in terms of what's driving headline and core inflation in the PCE deflator.
Dana Peterson, thank you for the brief. With the Conference Board and onto the Fed tomorrow in retail sales. Always important at the Conference Board on Thursday. Joining us now with terrific, rigorous mathematical analysis, Alicia Levine, Head of Investment Strategy, Equity Advisory Solutions. BNY Mellon. I want to talk about Jeffrey Yu's Euro call, but we'll save that for another time. You have a beautiful sentence in your report, cash will underperform. The known worlds in cash. Discuss.
Almost $6 trillion in cash. If you step back and say, what were the trades this year? It was AI, GLP-1s, and cash, and T-bills. So the question you say is, if I look into 2024 with an expectation that we're going into a healthy slowdown for the economy, the Fed's going to cut, we think, the second half of the year, not the first half we can discuss, and we have inflation moving in the right direction, where does cash lead you? And it doesn't lead you to the same return you had this year. And this is the time to start reallocating into other assets.
Where does cash go? Individual stocks? Does it go into ETFs? I mean, I'm fascinated within the equity space. Where does BNY Mellon see that the cash will migrate to?
So we think the cash goes to equities. It should be going to bonds, okay? Should be going to bonds, and we're actually calling for a 20% allocation to alternatives as well, because we think this is one of those really...
What's an alternative?
So distressed debt, privates, right? It's a great time for privates, actually, because you're getting the repricing this year into next year, and there's going to be distressed opportunities out there because of the rate hiking cycle. And so that is just a nice setup, and real estate as well, nice setup for an entry of new capital into this asset class.
Before we get stuck into that, just talk to me about cash, how sticky that is at money market funds. When you're making these recommendations to clients, they're jumping on board, still hesitant. What's the tone like?
So clients are receptive to this because with the understanding that what's worked over the last 12 months is likely not to work over the next 12 to 18 months. If you've been in markets long enough, you know that. The same trade doesn't take you far every single year. And on top of that, if we've hit peak rates, we've hit peak Fed, inflation is slowing, cash will underperform the bond market and equities.
Have we seen the distress?
So we haven't seen distress in large cap America. We're going to see it in small cap America and other areas that are reliant on refunding and funding growth. So that means, for instance, the small cap world, that the Russell 2000, 48% are non-earners. They need to borrow to grow. That debt that they're using is floating rate and comes due a lot sooner than the fixed rate debt from the large cap companies that took out loans in 2020 and 2021. So you're setting up a situation where you have some parts of the economy that are relatively insulated, termed out their debt at low rates, like households did with mortgages, and other parts that are more exposed.
Is there any inconsistency in being bullish on risk and also expecting a tick up in distress and bankruptcies?
So there's not an inconsistency because this is not a blanket call, right? The way we've sort of had a rolling recession over the last 12 to 18 months, you're going to get a little bit of that going forward. We do think there's some consolidation in the first half of the year, and actually in an election year when there's an incumbent, there's just a lot of creakiness in the market in the first part of the year as policies get discussed, different sectors are targets, markets, right, just you tend to have a bit of a slowdown and probably a digestion. We're going to have a year that's up 22 to 23% by the time we finish the year here. So, unlikely that continues in the next few months. It coincides also with if there's a slowdown, it's the first half of the year. Right, because incumbents tend not to like recessions when they're running for re-election.
Is there anything that we could see in less than a half-hour time that could shake your view on this sort of disinflation that allows this next leg of the cycle?
So it's the core, right? So energy prices look to be well tamed. To the discussion earlier that you all had here about the record pumping of oil and gas in the U.S. and also the warm winters everywhere. So oil prices seem to be well contained. If that's the case, the low oil prices will filter into every other sector. So the core prices today at 4%, we'll see what we get in a few minutes' time. That's where you could get a different narrative if it doesn't come down further. But to the point about whether the Fed cuts or not in March, it's just not realistic. And I'll point out in the last 18 months, the market has been overly optimistic on when the Fed has cutting. If you remember, we were talking about the Fed cutting in August of 22. The market has wanted that Fed cut for 18 months now. It's always been too optimistic for where the Fed's going and where reality is going. And if our call is right, more likely to have a soft landing than a recession, clearly not cutting in March of 2024.
I want to go to your math abilities here. There's a lot of Greek letters getting thrown around right now. Gamma, 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 and the rest of it. Alpha, beta, gamma, epsilon, blah, blah, blah. The skew is silent out there. Explain to our audience the silence that some of these volatility measures show right now.
Boy, 12, a VIX of 12, it's just shocking. But again, the VIX number is really about the volatility in the bond market. And the bond market right now is just well behaved since that CPI report back in early November. So the whole market for the last 18 months has been driven by the bond market, every other asset class. And as long as that is tamed, the VIX as well will be tamed. But look, it's a risk. It means at 12, it's historically very low.
What would you expect from Chairman Powell tomorrow?
I think it's his one chance to push back.
This is it, right?
It's his one chance. So I would expect something like that, because the easing of financial conditions can't be too pleasing for the Fed in their fight. And they will definitely fight back, I think, against that first half rate cut that we're seeing here. I mean, so, you don't want to say, calling victory too early, but he will definitely fight back here.
It's crystal ball type stuff, so forgive me. But do you think the market listens to him anymore? Is that a credible threat, given what we're all seeing in the data?
The data has been very kind to risk assets. So 8:30 today is really the key. More so CPI than Powell, but I expect Powell to push back against all this excitement. And look, the risk in the market is that everybody's expecting a soft landing, right? That's the risk. Where were we all a year ago? Recession.
A year ago, 2 months ago. 2 months ago, TK.
Did she just say we're going to cash? Is that what I heard? Even off inflation?
You ask me that every time. So we are never in cash because...
Okay, there we go.
That's you told.
A domestic to my right, domestic to my left.
No, but let me just say this. A year ago, you said, so how do you avoid going 5% in cash? And I said, well, we do relative allocations. We never go to cash. And we were over-allocated to U.S. large cap. Because if I'm worried about recession, where do I want to be? And that's U.S. large cap. So that was a great allocation for our clients this year.
You wanted to be in the NASDAQ 100 at 48% year to date, which is just absolutely bonkers. That is nuts.
Timely is a key idea there. Maybe the inertial force of disinflation back to wherever anybody chooses that we should head. Very sophisticated in this analysis is Lindsey Piegza, and joins us this morning. Lindsey, thank you so much. And on this moment of inflation, if you will, what I find fascinating is getting the last mile. Let's say we're 3.8. Getting to 2.8 is a whole different story than what we've seen the last months.
Absolutely. The last 100, 200 basis points is always the most difficult. And to your point, it's not just the nominal level of inflation, but it's the underlying momentum of disinflation that the market is really looking for. We want to be convinced that we're on that sustainable downward trajectory. And if we look at the third quarter, with that recent backup and then sideways movement, that's not convincing that we are on this sustainable, timely trajectory back to 2%. 2%. So my concern is the longer the Fed remains on the sideline and slow plays inflation, the bigger the risk the Fed will have to come back in and take further action and maybe slow the economy more than they would have otherwise needed to if they'd simply dealt with inflation the first time around.
Let's get into it. Where are the improvements coming from over the last 12 months? Where have they come from?
We've seen some widespread improvements in terms of inflation. It's moved over from the goods side into the service sector, widespread. But again, a lot of that downward momentum, a welcomed gauge as we move into the key holiday spending season, is from energy prices. And so when we talk about the reversal there, that's probably not a long-term sustainable trend. We could see bounce back up in the first quarter, again, forcing the Fed's hand maybe to take further policy action.
One thing we've asked regarding the Fed is how much of the improvement in inflation is down to the Federal Reserve and how much of that is just a natural rebalancing of the economy. It's come from the supply side. I know it's tremendously difficult to gauge, but if we're going to talk about the prospect of higher interest rates from here, we also have to understand what higher interest rates have done so far over the last 12 months. What have they done?
I think the Fed can take responsibility for the improvement that we've seen on the demand side, certainly not the supply side, not the good side of things, as you talk about the recalibration in the aftermath of reopening the global economy. But on the demand side, we have seen the consumer pull back. Momentum has slowed from double-digit growth down to 8, down to 6. We're now at low single digits. Consumers are still spending, but at a remarkably lower pace. So that loss of momentum, I think we can attribute to the Fed. But clearly, they haven't done enough to see below-trend job growth, to see below-trend spending activity, and certainly not enough to get that prolonged period of below-trend top-line activity to ensure a return back to stable prices.
Just wait, that's Mike Wilson's message. And what we hear from certain executives like that of Hasbro seems to be something similar. They are seeing a deceleration in consumer appetite. We heard the same from Walmart. How do you pair that idea with some of the recovery that you're seeing in services and other areas that you think could fuel inflation again next year?
Well, this is the big concern. Do we wait on the sideline and hope that inflation slows, or do we take further action to ensure that prices slow? And from my point of view, I don't think the risk is that the Fed tightens too much, but that the Fed doesn't tighten enough and allows inflation to become further entrenched. And this is really the mistake that they made on the front end. If we go back to the initial start of the tightening cycle, they held on to that transitory language too long. They allowed inflation to become too ingrained, and we're now trying to deal with, particularly on the wage side, these ingrained levels of price pressures that are complicating this process to get us back to 2% inflation.
What should they look for to be confident that they can start easing?
Well, one, a downward sustainable trend. This back and forth sideways movement doesn't instill confidence. But second, we need to see broad-based improvement in some of the most sticky components, particularly wages. And last Friday's employment report didn't give us that confidence. We're still talking about 4% annual wage growth. We have come down from peak levels, but that's not enough to suggest that we've done enough in terms of tightening.
On behalf of 331.9 million Americans, can you explain the USDA, the Department of Agriculture, tells us in October we had 3.3% food inflation. No one is experiencing that. Food inflation is just shocking at the grocery store, at restaurants. John had a $68 steak the other night, whatever. But the answer is the reality. This is what I get 24/7. The reality of inflation is totally different than the verbiage of people like you. What's the divide here?
Well, I think a lot of the differential is the wholesale prices versus what we're experiencing as the end consumer. Because we're not going down, we're not buying the fish at the market, we're buying the fish at the restaurant or at the grocery store. And that is the pipeline of price increase that the consumer is feeling. And so 3% food inflation, no, we're not feeling that. We're feeling more like 15, 20% food inflation. But from the Fed's perspective, again, they're looking at the broad-based components of inflation that regardless of where in the pipeline they want to look, we're still above 2%. We haven't gotten back to price stability.
Right.
There's more work to be done despite the market's consistent overreaction and constant calling for rate cuts. Fed officials are still talking about reaching that sufficiently restrictive level.
The Bloomberg Financial Conditions Index, the Goldman Sachs Index, somewhat the same, all show accommodative structures right now. Part of that is a buoyant stock market as well. Into this meeting and with this report in 90 minutes, are we restrictive or accommodative now?
Well, that's the question. Are we really as restrictive as the Fed thinks? Have we reached that sufficiently restrictive level? And some of these indices say, no, we have not done enough. And when you look at growth...
So are you talking about a rate increase?
I think it's not out of the realm of possibilities that we see a further rate increase. If we see stability in inflation, and then as we move the calendar page into 2024, we see a little bit of an uptick, I think that could force the Fed's hand to take one final rate increase to convince the market that 3 is not the new 2. Orange is not the new black. We have to get back to 2% inflation, and they will not tolerate an above-trend level.
Why is 2 so important?
Because that's the balancing level of inflation that allows the economy to continue to accelerate without moving into a hyperinflation scenario, but also keeps the economy afloat and avoiding the deflationary scenario. So it's a delicate balance that the Fed is trying to walk. And we don't have to pinpoint exactly 2% inflation. Remember, it's the longer-term average. So as we fail to reach 2% for the better part of a decade going into the pandemic, arguably the Fed may be willing to tolerate slightly higher inflation. But again, it's about that downward trajectory of momentum that we haven't established.
I just wonder if we become too focused, Tom, too myopically focused on this 100 basis points. I remember from the other side of it, at 1, searching 2, and all the effort that global central banks went to try and get inflation up, Tom, 100 basis points, whether the effort required to get us down from 3 to 2 would be equally damaging in a different way.
There's been a lot of study on this, starting with Blanchard and Stiglitz at the IMF off of 07, 08, and of course it's been rekindled 3 or 4 times forward. Olivier Blanchard's book last summer addressed this directly, linked into fiscal policy. And the answer here is, how much work does it take? And the answer is no one knows. And the other answer is, it's got to have a price, it's got to have a cost at some point. To me, Lindsey's job is to aggregate everything that's out there. And my answer is, we're a disaggregated America. We've got a haves, technologically laden. They don't care about inflation. They're off skiing somewhere.
Who's that?
Pine Tree, Vermont.
Federal Reserve officials.
They're off at Pine Tree, Vermont, wherever. The rest of America's flat on their back.
All right. I'm not going to say anything.
Oh, right. I thought you had something to say.
No. Okay. I'm just sort of, we can move on now.
Okay. You want to move on now? You've been going skiing. Is this about you?
I went skiing this weekend. Okay. Yes, it was the first skiing of the weekend. That's what that was about.
Why am I missing the inside jokes this morning?
Because you weren't here yesterday. See what you missed?
You missed us singing White Christmas.
Was he trying to bully you? We're going skiing.
Look, it was great. I enjoyed it. I'm feeding into the, consumption of America.
Good
Keep
for you.
This economy strong.
America. Nice. Lindsey, thank you. That was a clinic.
Thank you.
It really was. Thank you very much. Lindsey Piegza there of Stifel.
Right now on oil, Christyan Malek joins us, Managing Director, Global Head of Energy Strategy at JP Morgan. On oil, John, we did this yesterday for you. We missed you so much. A gallon of petrol from the peak down 32%. And I guess that's part of the inflation story. Christyan, 2 years ago, you were modeling out oil demand led by emerging markets that would put a bid to oil. Is that theory still in place, that EM and developing economies will find a bid, have stable or increasing demand on oil, and lift the price?
If anything, hey, Tom, I think it's strengthened. There is demand in the world that we just simply cannot see. So when we're trying to modeling demand from a scale of 1 to 10, we're going from 7 to 9, there's demand that's negative that's going to be positive. So in other words, there's demand in the EM world, penetration of energy poverty that we see today, where they would love to consume any form of energy in order to high grade themselves out of poverty, whether it's lights on the street, whether it's being able to get to work. So that demand, that intrinsic demand that is not visible, is so significant that we don't see demand peaking. I don't think we'll see demand peaking in our lifetimes, particularly as EM demand growth continues to surprise the upside.
Which is really counter consensus, considering people were talking about peak demand for quite a while. Christyan, let's go through the outlook that you just put out for next year, talking about how prices could stay around here or go a bit lower, as you do have U.S. production reaching all-time records, offsetting some of the cuts. But then what? What happens in the second half?
Right. Well, it's interesting. I think we've had a lot of discussion around these additional barrels that we don't see necessarily coming from the U.S. shale, coming from deep water. And look, credit where it's due, these guys have done a great job in delivering additional productivity and therefore more production. I think the key point that we make from the second half going into next year is that these are all additional barrels. These are tens of thousands of barrels. They're not millions of barrels. There is no massive quantum of volume that we don't know about that's coming into the market over the next 2 to 3 years. And that ultimately means that it's not if, but when does the market tighten, even as we see potential surprises. So I've obviously seen a lot of discussion around surpluses next year. And we can talk about OPEC, but in the end, the biggest asset test or litmus test, if you like, in terms of when do we know the market's starting to tighten, when OPEC, led by Saudi, adds volume into the market. That's not a negative, that's a positive.
What's been most surprising to you this year, Christyan? Because so many people got the call wrong that oil prices would be substantially higher. Why are people so confused by what's going on in crude?
It's a great question. I think there's a couple of reasons. Let's just unpack that. First of all, there's a lot of dark inventory led by Russia, Iran, Venezuela, Libya. That is exactly why this time last year we went bearish. Despite our super cycle call, we went bearish into the first half of this year simply because there's a lot of volume that we just couldn't see. At least with shale, we can see it. This was inventory that was in excess. So that's the first point in terms of the sort of volatility that we saw. The second is the risk premium, which is introduced through the conflict in the Middle East, where there was concerns around potentially widening of that conflict, and that clearly created a bid to the upside. I don't think the premium's gone away, but it's something we need to keep an eye on. Now, if we're thinking about that in the context of how do we see oil prices going into next year, I think probably the biggest learning curve for us in terms of discovery is the marginal cost for oil. I've seen a lot of discussion around surpluses and deficits. In some ways, if you can be critical, you can make it what you want. The reality is what you can't change is the marginal cost of oil. That has gone up. It's gone up significantly. In fact, if you look at the curve structure in the last 7 years, it's basically moved higher over time. And so why is that relevant? Because if the marginal cost of oil is going up, it's getting more expensive to produce, whether it's because of cash return from the majors, supply chain bottlenecks, etc., then we can look at the time when oil went to $70 in April through the banking crisis and take heed from that. That potentially does start to look like a floor. We're in discovery. I'm not going to try to call that as a hard floor, but that to me sounds like a relevant floor as we think about going into next year in terms of the range. And that's why we've talked about 70 to 90 is the range. It'll be volatile. But let's not forget that the marginal cost of oil is going up, and that typically is the early leading indicator of an upcycle.
This confidence, Christyan, that you have goes beyond 2024. You and I have talked about this before. Right. Talk to me about why it is that you can make this call and push it out beyond 24 into 25.
There is no significant volume of oil coming to the market in the into the rest of the decade. All the volume that we know, we can see. If there's additional upside, fair enough, they could create volatility to oil, but there's no major quantum, not like the North Sea in the 80s, not like shale in the last 10 to 12 years. And so with that in mind, it's just a matter of time before the market significantly tightens. And as the market tightens, and we expect the second half of the decade, we'll see severe tightening. That is the point where the only real quantum of volume that we can rely on and lean into is OPEC. So when people tell me, oh, OPEC is cutting, it's a bit like the 80s, they're getting weaker, I sort of reverse this and think almost like the art of war here. They're retreating in order to advance. They're going to take share of demand growth in the future when all the big volume out there has diminished. And again, I stress big because I'm not saying that we won't see more volume, but not in the millions of barrels that we need to meet that future demand growth, which is at least going to be between 107 and 108 million barrels by 2030, if not higher.
What's the signal that you take from the consolidation that we've seen on the US side of things in places like the Permian?
Yeah, it tells me two things. One, that these companies now struggling to significantly raise productivity on the land they own. So they're having to now pay a premium using paper to gain more land in order to take productivity and efficiencies that they've got, apply it to the land that they've acquired and raised. So this is definitely a narrative of efficiency. It's a narrative of increased productivity, but it's sort of a double-edged sword. It's telling you that they don't have it themselves in their own portfolio. They're sort of maxed out on productivity, which is clearly bullish. But equally, that means that there's more wood to chop on what they bought in terms of the acreage to raise the productivity to the standard that they're on, for example, Exxon. So while that means we'll see potentially more volume hit the market over the next 2 to 3 years, I wouldn't underestimate the productivity gains. It feels to me as a short duration call to the upside, because what these deals are telling you is that beyond 25, 26, we're now seeing a significant reduction in new inventory that can hit the market. And therefore, I'm not necessarily going to call a peak on shale. Shale will continue to grow. We actually need shale. We don't want prices going very quickly to 150. But shale as a sort of as a basin that's going to grow every year by $1.5 million based on where the oil price, I think those days are over. Now we're sort of in steady state, and we'll see additional volume, but not significant.
Hey, Christyan, you're one of the best. Appreciate it, as always. Christyan Malek there of JP Morgan.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.